Gonna be a we're just gonna do 1 week, week 10, and we're gonna be talking about trade finance, and it's gonna be a shorter lesson, but you guys will have some in-class activities today. Also, remember you have a quiz next week, so quiz 3. All right, the trade finance process. We'll get into this. Actually, you guys are going to basically read this, understand it on your own. Just pause the video, read it, understand it on your own, because this might be on your quiz. Okay, I'm not going to go into too much detail on it, but once we finish this entire slide, this will all make more sense. Okay. So what is trade finance? Trade finance and how it works. The function of trade finance is to introduce a third party to transactions to remove the payment risk and supply risk. Okay, so basically, when you're doing trade finance, you're looking at a third party such as a bank or finance companies, importers, exporters, insurers, right? Just so you can mitigate, you can remove any type of risk of not getting paid. So trade finance provides the exporter with receivables or payment according to the agreement, while the importer might be extended credit to fulfill the trade order. Like I said, banks, trade finance companies, okay? So what's credit insurance? Credit insurance is a type of insurance policy purchased by a borrower that pays off one or more existing debts in the event of a death, disability, or in rare cases, unemployment. Okay? So credit insurance is, let's just say you have 5 credit cards, each has like $10,000 on it, and usually you're paying them off, right? You're doing your monthly payments and all that stuff. Now, if you have credit insurance, let's just say that you pass away or something happens where you're unable to pay your insurance, you're unable to pay your credit back, then this insurance would kick in and it would pay it off for you. Credit insurance is marketed most often as credit card feature, right? Like I just said, with a monthly cost charging a low percentage of the card's unpaid balance. Credit insurance can be a financial lifesaver in the event of certain catastrophes. However, many credit insurance policies are overpriced relative to their benefits, as well as loaded with fine print that can make it hard to collect. So a lot of credit insurance sometimes there's a lot of fine print, a lot of crap. Like sometimes we have life insurance. Companies don't even get, people have been paying life insurance for their whole life, and then when they do pass away, for the family to get that money from the insurance company is extremely difficult. They actually don't even pay it out. So it's life insurance and stuff like that is sometimes, depending on what company, is a huge scam. So what are some types of credit insurance? So credit life insurance, right? So it pays off all your loans if you die. Credit disability insurance is also called accident or health insurance. So if you get into any accident or have any health issues, like the people get cancer, they get illnesses, stuff like that. This type of credit insurance pays a monthly benefit directly to a lender equal to the loan's minimum monthly payment if you become disabled. And then credit unemployment insurance. So basically, if you lose your job, your credit would be taken care of. So your loan's minimum monthly payment. So if the minimum monthly payment is $100 for your credit card, it'll pay that minimum monthly payment. Risk mitigation. Risk mitigation is a strategy to prepare for and lessen the effects of threats faced by a data center. Comparable to risk reduction, risk mitigation takes steps to reduce the negative effects of threats and disasters on business continuity. Threats that might put a business at risk include cyber attacks, weather events, other causes of physical or virtual damage to data centers. So basically, risk mitigation is doing everything you can in order to lower the risk of anything happening to your business, okay? Anything bad happening to your business. So basically, guys, the way I see life is a game of chance. Okay, so the higher the it's all about chance. It's all about probabilities, right? So you want to make sure that you have the highest probability of being successful. Now, how do you do that? Obviously, don't do drugs, go to school, get a job, make money, right? That's how you become rich. That's how you become successful. Now, the higher, if you continue to do stuff like that, the higher the chances of you becoming successful. Now, if you want to become successful, but what you're doing is you're smoking, you're drinking, you're partying, you're, doing stuff with your friends, going on vacations, not really working, not going to school, the chances of you, the probability of you becoming successful is very low. Okay, so that's what life's about. Life's about probabilities, right? Like we never know when we're gonna die, but what we do is we try our best to eat the best food, exercise, live a stress-free life, in order to increase the odds, increase the probability of having a good, healthy life, a long life. Now, things can happen, right? That's why you get insurance, right? Because things can happen. What risk mitigation is doing all the things in order to eliminate or to significantly decrease any any risks that may occur from what you're doing. So for an example in business would be, let's just say a business is selling a part, like a car is selling an engine, a car manufacturer is selling an engine manufacturer, and they know they have their car, they have their car is their engine is a high performance engine, and it is known that high performance engines burn a lot of oil. So for them to reduce their risk and have recalls and callbacks and stuff, they're going to do their best to try to mitigate that risk by trying to fix their engine to not have any recalls. Okay, because recalls cost a lot of money to the company. So it's basically risk mitigation. All right, guys. So we're going to be going live in class today. Um, a video and a question will be posted. Um, but mostly I want to kind of go over the stuff for week 3, the quiz 3 next week. Okay, so we're going to be doing that more than learning about what we're doing right now in class. So a lot of revisions going to be going on. I'm going to go through some of your videos just to see, give you guys some feedback. And I will be posting a video right now, and I want you guys to watch it right after this PowerPoint slide because we're going to be discussing that in class too. All right, so I'll see you guys in class.